Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This coming week sees the latest inflation data coming out of the Eurozone, taking place over the course of the 30th and the 31st of July. So we're wrapping up the month with a big focus on inflation in the Eurozone. And that begs a question, is it going to set us up for an interest rate cut from the ECB? Does it highlight a move in the right direction, or are we going to see inflation stutter based on base effects? Let's get into it. First and foremost, this is the outlook in terms of the data we're looking out for. Of course, we see typically some regional numbers leading into that wider Eurozone figure. So we've got the Spanish figure early morning on Tuesday, and then in the afternoon, this is UK time, in the afternoon, we've got the German data, French data on Wednesday morning, and then 10 a.m. we've got the Eurozone numbers. What's notable here is that we've got this forecast for the Spanish number on a monthly basis of minus 0.7. And this really highlights something for this month, that we have got some seasonal effects coming into play here. We've got the same kind of thing for the French number, minus 0.4. And if you look at the Eurozone figure, the monthly figure is expected to come in at minus 0.3. So we're talking about significant disinflation that could really lift sentiment within markets if we do see them coming out with a figure as low as 0.3 or minus 0.3. So we'll look into it anyway. So first and foremost, this is the picture in terms of Eurozone interest rates. We can see that recent rate cut setting us up for a potential period of looser monetary policy, where we see these rates cut after a very dramatic period of tightening. In terms of inflation, I did highlight the fact that we are looking for a very weak number. And I looked back historically and picked out the July periods, and this is the month that we're going to be looking at this time around, and noted that each time around, July was an outlier to the downside. So, some months that meant that it was a negative reading when it straddled by positive readings that we could see last time around, minus 0.09 or minus 0.1. The prior time before that was a case of seeing there were some really strong monthly figures around that time, massive readings. But then we saw a drop down to 0.1, 0.11. The time before that, minus 0.1. Before that, minus 0.35, and then minus 0.47. So pretty much every July, we see either negative figure on a monthly basis, or we see a very low figure in relation to the other numbers at that time. Now, here's a breakdown in terms of the headline inflation gauge is 2.52 at the moment. We're seeing the figure from last year stripped out, and as I've highlighted, it's minus 0.09. So minus 0.1 being stripped out. So for us to see further disinflation, we need to see a figure below that minus 0.9. Now, we know that the market expectation is for a figure around minus 0.3. So, two different ways to be looking at it. This one way you could say, okay, this looks great. It looks like we're going to see this really low figure. We see it each time around, and we're going to see it again. And therefore, everyone's going to think, woo, brilliant. We're seeing a negative reading on the monthly. And so it's all hunky-dory. And the flip side, you could say, well, markets are already expecting a minus 0.3 figure. So for them to be surprised to the downside, what we're going to have to see is minus 0.4, 0.5. So it's making a little bit of a rod for its own back. But nonetheless, I would say that if you're looking at periods where inflation is relatively low, as it has been over the last 2 months, historically, we do see pretty significant downside moves for the July metric. It's only really when we're seeing very elevated monthly figures that we have seen back in, say, 2022 and 2021. That's when we actually saw figures that are closer to the zero mark, whether it's 0.1 or minus 0.1, that kind of thing. So there is the potential for this downside move. And if that comes to fruition, then we're talking about a potential for further disinflation. It's at 2.5 now. And, ultimately, if we're in a position where we're managing to still drive down inflation, even when stripping out from a base effects perspective, that minus 0.1 figure, it stands us in very good stead because, of course, we look through to next month and the August reading is 0.54. That's for last year. That's what's going to be dropping out. So if you look at the last 2 months, they've been around 0.2. Let's say we do see this disinflation this time around. Let's say markets are right with their expectations and we take the headline inflation rate down to 2.3 from 2.5, then you'd be looking at, let's say we see another 0.2 coming in, we strip out the 0.54, we're back down to target. So things are looking like they're shaping up very well over the near term to get back down to target or in that area. Now, it might not necessarily be the case in terms of the core CPI because we don't necessarily have the same expectations of really significant disinflation. Again, let me just go back to the expectations. You can see in terms of core inflation, markets expecting to go from 2.9 to 2.8%. So gradual disinflation on the core figure. It comes down to whether the ECB are just going to be pernickety and think, well, we only really want the core number to be coming back down to target. You can see that we've got some very chunky figures at the beginning of this year: 0.67, 1.1, 0.7, 0.44. Across those four metrics, we're well above that 2% mark. And then you've got these negative readings that are going to be stripped out in January and in November that, when they're stripped out, we could potentially see some significant upside. So we are seeing this sort of divergence between what's happening in terms of the core metric and the headline metric. But certainly as things stand, it looks like a month that could see the headlines being taken by the fact that we're seeing a really strong downside move in terms of monthly disinflation, and that we're also seeing a nice move towards the downside in terms of headline inflation, which could point us in the direction of an interest rate cut from the ECB around the corner. We can see in terms of the composite PMI reading for the Eurozone, we did see these PMIs recently and they pointed towards weakness. Certainly it's a mixed bag because generally it's a manufacturing-led period of weakness, but nonetheless, certainly Germany in particular showing signs of weakness. But when we're seeing weakness in terms of the economy and we're seeing downside in terms of inflation, it points towards further monetary easing from the ECB. So first and foremost, let me just jump onto the expectations for the ECB. You can see 65% chance of a rate cut in September. So we're talking about these expectations being enhanced or diminished. Then you're looking towards year end and you're saying, okay, well, markets expect to see 2 rate cuts essentially by year end. So 3 meetings, 2 rate cuts, it seems achievable, quite frankly. And certainly if we see a nice move towards the downside in terms of inflation, it should give us greater confidence of that. This is a chart that I had up from the whole French election thing, but certainly there's still some question marks around France and this relationship between the French CAC and the German DAX does highlight that we're seeing a bit of upside once again for the French 10-year yield relative to the German 10-year. And ultimately, we're seeing outperformance for the DAX anyway, irrespective of the moves that we're seeing now. Ever since that French election, we've been seeing the DAX really outperforming. So what better place to start off than the DAX? So we can see the pullback recently coming in line with the weakness in the tech sector over in the US. Let me just get this on full screen. So we've seen a bit of a pullback. It's certainly not been anything like what we've seen for the US markets, to be fair. And you can see if we're looking at near-term price action, let's just go here. So you can see recent pullback 1.87, 4% essentially there for the S&P 500. But certainly it's sort of run away and now pulling back. The DAX really in sort of consolidation mode at the moment. The 4-hour chart, we can see that we have come into a new lower low once again. And you can see that we're also seeing lower highs on the top end. So you could say, well, is this a precursor to us rolling over? There is a possibility of that. And certainly if we do see this inflation gauge coming in higher than expected, then we could possibly be seeing another retracement before we see the bears coming back into play. But the wider trend still does remain bullish for this market. I just want to quickly put on a deep fib zone and show you some resistance level. 18439 and 18520 are the two deep levels, the 61.8 and the 76.4 fib. So as it stands, you can see this creation of higher highs, higher lows into lower highs, lower lows. It points towards the current rally potentially being at risk, but I would say that, you know, it also depends on, excuse me, it also depends on what's happening in terms of the wider markets. Bear in mind, of course, this doesn't act in isolation, the DAX, and we're also going to be seeing a whole host of data points, whether it comes to the BOJ, the FOMC, earnings from 4 out of the 7 Mag 7 names. There's a lot going on in this week. So it's not to say that everything's going to come down to this Eurozone inflation gauge. But if we do see that disinflation move, then there's a good chance, you know, if we look out on this daily time frame, I know that it looks like we're sort of rolling over, but by and large, we're sort of in consolidation mode following that sort of rally. We retraced here. We started to regain ground. We broke through resistance level. So I think there's a good chance that this is ultimately going to resolve towards the upside, quite frankly. But as it stands, we are still seeing this move towards the downside. So a break up through 18652 would certainly give us greater confidence that the bulls are back in charge. But key to this will be this inflation report. And if we do see that minus 0.3 on the headline figure, that could really give people greater confidence. Here is euro dollar, certainly coming off the back of the latest core PCE inflation metric. It does put back expectations for the Federal Reserve in terms of their easing in September and November and December. But nonetheless, what we're looking at here at the moment is upside. And upside, a lot of it is being driven primarily from a sort of recovery play that's taken shape at the back end of this week. We saw that risk-off move centering around earnings. And this does highlight that we're not just looking at what's happening in terms of the economics. We're also looking at what's happening in terms of earnings. And certainly big tech earnings, you know, let's say we suddenly see a big collapse in inflation that points towards lots of easing from the central banks, but then we see awful earnings for some of these Mag 7 names. I think it's more likely that we're going to see a massive sell-off because those Mag 7 names have such a significant weighting on them. But nonetheless, as it stands, we're looking to potentially see some weakness coming into play here. You can see here this pattern of higher highs, higher lows, with the little head and shoulders formation on the top end. And now we're doing that sort of stepped move lower from the top as well. So unless we break the 109 mark, then this near-term rally could falter once again. And certainly if we're looking for potential movements around this release, we're going to be looking for the potential for us to become even more confident around a very loose monetary policy from the ECB, and that comes down to whether we see that minus 0.3 or below headline inflation gauge on a monthly basis, which could point towards this market rolling over after a period of strength that has dominated the first few weeks, essentially the entirety of July, but certainly the first few weeks. So potentially seeing a top here. But we need to stay below that 109 level for euro dollar to roll over once again.